Let's turn our attention to one of our core investment framework guidelines, which is inflation. Let's look at the path, but then sort of the terminal level that we see through next year, and talk about how that relates to what the Fed can and can't do with respect to the sort of the terminal Fed funds rate they can achieve.
Yeah. So we'll touch on the inflation forecast first. And, this hasn't changed a whole lot. We see high and falling inflation. That was obviously confirmed by the October CPI numbers. That was the first time CPI had come in cooler than expected in a long time. And it's crazy how Jerome Powell's tone can change when you go from August Jackson Hole inflation coming in hotter than expected every single month since fall 2020 to get 1 month of cooler than expected inflation. And now all of a sudden soft landing is plausible. And we might be able to do this, right? So the data is definitely behind him when he spoke most recently. So it's still high and falling, but we've been saying over and over that's good news, bad news, right? Good news is falling, obviously. Bad news is high. I mean, out to 12 months, we're still looking at headline or core CPI running in the fives. And that's the year over year number. Mm-hmm. So it's also important to look at the momentum here. So if you look at our expectations for the month over month, 12 months out. So what is the month over month going to be? October 2023. Those are still running at 5% plus. So that to us means, Jerome Powell, you might be able to puff your chest out right now, but your work is not done. And there's not going to be a lot of compelling evidence of inflation coming down probably for at least a few months. And then even then, you may say you're done hiking, but there's no reason why you should start cutting.
Right. Yeah. So to put it in simpler terms, the idea of a pivot coming anytime soon, forget about it. There's just no way
the
they
pivot
can.
Hopers,
Yeah, for the pivot hopers can. So don't invest on that thesis, because that's just a narrative that's false. And I think the other important thing is what extended periods of these rates being this high are going to do to some of these companies, these zombie companies that have existed in a low rate environment and now will be 12 months into these higher rate environments, and how that might impact labor and earnings, et cetera, going forward. So this is a newer chart. I don't think we've shown this one before. And that's sort of the expectations the market puts on where the federal funds rate will peak. And sort of take us through what this is telling us.
Yeah, this basically, it shows exactly that. For each rate hike cycle, what does the market think the Fed funds rate will peak at? And so that's the blue line. And you can see since, how you would read this, you would look at, say, May 2020. And you would look at that and say, well, over the next 5 years, that May 2020 dot, each one is the peak over the next 5 years. We expect the Fed funds rate to peak out at 0, meaning no rate hikes for 5 years. And then you can see how it took off. Immediately once, economic growth started coming in better than expected and inflation started picking up, now nobody can call the peak. You just have to keep revising up your expectations for the peak. How high is the Fed going to have to hike interest rates to finally kill inflation? And as that blue line has gone up, especially as it's gone up above the green line, and we'll explain the importance of that later. Once it starts going up past the green line, that's when stocks and bond prices go down simultaneously. That's tough. And now very recently, if you could zoom in, that's sort of the last month or two, what you see is the blue line has stopped going up. Everybody has coalesced around this idea that the Fed will be done hiking in about March of next year, that they're going to do a half a percent in December, and then 25 basis points in January, another 25 basis points in March, and that's it. Peak Fed funds rate for the cycle, 5%. Blue line stops going up. Okay, it's safe to go out and buy stocks and bonds again. And that's why you get this little bear market rally, right? But so exactly as you're speaking to, that is pivot hopers, right? That is, in our view, the exact wrong mental model for thinking about how monetary policy actually works in the real economy. The first thing that is underappreciated is monetary policy works with a lag. Okay. If the Fed stops, even if they stopped hiking in December, the worst of the economic slowdown would be ahead of us because the first rate hike would have been 9 months. If they stop in December, the first rate hike would have been 9 months ago. And so you could argue that all of those rate hikes have yet to even impact economic growth. So that's the first thing. Monetary policy works with a lag. And then two, the level matters. The level is very important. That green line is the Fed's estimate of the long-term Fed funds rate. This is the closest thing to the neutral rate of interest you have. The neutral rate of interest is the level of short-term interest rates that are neither restrictive or accommodative. And so if you're above that line, that means monetary policy is restrictive. If the Fed slows the pace of hikes and only hikes 0.5%, and then only a quarter, and then only a quarter, and they stop, they are stopping at double the neutral rate. Meaning, even if they stop there and hold it, the level matters. Monetary policy will be restrictive. And the long-term effect of having short-term interest rates in restrictive territory is negative for economic growth.
Right.
So that's the other thing that's underappreciated. It's not good news that they're stop. I mean, you could say they're slowing down. Okay, that's good, but the level matters.
Right. And the time above that level matters, right? Because it just puts more and more pressure on businesses and cost of capital, et cetera. So let's move on to liquidity. Now we got some updates to our liquidity forecast, just minor ones, but they matter. I think it's important for us to sort of talk about the current month change in liquidity and what it's telling us in our projection forward.
So after updating our models for everything the Fed did during the month of November, what you see if you zoom into our forecast horizon is less of a rebound in liquidity than we were previously estimating. So on the margin, that's obviously slightly worse in terms of our framework. And why that's happening, previously we spoke about how the Fed is supposed to reduce the size of their balance sheet by $95 billion a month by letting maturing treasuries and maturing or prepaid mortgage-backed securities roll off their balance sheet. And they had underperformed that target pretty much since they started quantitative tightening in the late spring. But November, they achieved it. They got it. They had full balance sheet runoff for the month. And so that leads us to change our expectations going forward. I mean, previously we expected they would underachieve their target for monthly quantitative tightening. And now going forward, that doesn't seem appropriate. And so we slightly revised up our expectations for how quickly they'll run off the balance sheet. One. And so that brings the liquidity line down. And then two, the types of money that they're money, but they're not really true liquidity in the economy. Those two things came down as well. So that's specifically the Treasury General Account. For whatever reason, during the month of November, the Treasury felt it was more appropriate to draw down their account at the Fed to pay for expenditures than it was to issue new debt. So the Treasury General Account came down pretty dramatically. And then reverse repo came down slightly. And so all those things factor into money supply growth just being lower for longer than even we previously expected. And
again, for the viewers, money supply growth correlates highly to equity levels.
Yeah, equity prices, particularly growth equities, low and falling liquidity environment that we're setting up for. Tough things happen. You look at what's going on in crypto, if you view that as sort of the ultimate speculative liquidity sensitive assets, no coincidence that these things are happening at the same time.